Let's get right to Steve Leisman for more on what we learned from the Fed yesterday. Steve, and you were kind of handicapping this balance sheet discussion yesterday as well.
Yeah, we talked about it yesterday. We've talked about it before. Actually, going back, Mike, the first mention by a Fed official of balance sheet reduction was September 28th by Bullard. He talked about it again in October, again in November, and then Waller. Talk about it just a second. I'll get to that at the end about this little St. Louis axis that's developing on the Fed. But minutes to the December meeting suggesting that the central bank could be more aggressive in both raising rates and reducing its $9 trillion balance sheet quicker than expected. The minutes did not put a timetable on when the Fed might begin the runoff, but they said, quote, current conditions could warrant a potentially faster pace of policy rate normalization. That's Fed speak for raising rates and or reducing the balance sheet. The Fed, by the way, is still going to be adding to its balance sheet through February. Now, markets are now dialing in a better than 73% chance of the first hike coming in March, with solid probabilities. As you move to the right, those are other hike probabilities. Solid probabilities of a second hike in June and a third in November. Even, by the way, now, a 40% chance of a fourth hike in December. So here are among the options for reducing that balance sheet discussed in the minutes. Well, begin sooner than last time. Good agreement on that. Possibly relying more on runoff more than rate hikes to tighten policy. Reinvesting mortgage-backed securities as they run off their proceeds into treasuries so the Fed's balance sheet ends up being only treasuries. Finally, cap the total runoff. J.P. Morgan writing after the announcement yesterday, we expect the FOMC will phase in a $100 billion monthly cap on runoff, double the maximum pace its balance sheet was reduced during 2017 to 2019. To fight inflation, the Fed needs to move rates up and tighten financial conditions. Its previous actions have received only a muted response in that regard, so a more aggressive policy on the balance sheet could force rates higher in an effort to tighten, and equities could be collateral damage in that effort. Guys, Mike, if you remember, it's with Bullard, and then it was Fed Governor Chris Waller. What you need to know about that, you probably know, is that Waller was Bullard's research director. So we have a bit of a, I don't know what you want to call it, the St. Louis Arch now on the Federal Reserve policy here that are leading, the hawkish arch from St. Louis that are leading policy here.